Yes, Jedi options today. We're going to take a look at a collar trade, specifically how to manage it. How to manage it. So let me break it down. We're going to use Urban Outfitters as the example. We talked about that earlier in the show, had an earnings announcement. Let's say you own the stock, okay? One way to think through the impact when you do a collar is to look at the risk graph. For those that don't know about risk graphs, we've done many Jedi option segments on these. So you can go back and watch those. But effectively, it's a picture of your trade. And with a collar, you own the stock. And so you've got like a 45-degree line on this risk graph showing that you have unlimited upside. That is the case with when you own stock, right? Open-ended upside. But you also have the open-ended downside, right? That's the risk with owning stock. And it's tricky going into an earnings announcement because often the stocks move a lot. Sometimes they move up a lot. Sometimes they move down a lot. But you're entering an uncertain situation with open-ended possibilities here. A lot of potential upside, a lot of potential downside. Some people don't like that. They say, I want to crack down on the potential outcomes here. And so I'm going to collar the position. I am going to reduce the downside risk. And to help pay for that, I'm going to reduce the upside. So effectively, what you do here is you sell a covered call, which caps the upside at a certain point, and you use that to buy a protective put. So for instance, if you bought the stock at 100, maybe you sell the 105 call, and maybe you buy the 95 put. And when you look at the risk graph, that caps how much you can make on the upside because the covered call, but the protective put limits what you can lose on the downside. So you have a risk graph that looks more like this, where you have limited upside, but you protect the downside. Well, suppose you did that, okay? Suppose you did that on Urban Outfitters, okay? This stock's been going sideways for the last 6 months, but as Matt mentioned earlier, there's been a lot of big moves in retail stocks on earnings. And so you're coming into this event today or last night, and your stock's at 27. You're like, well, could go up a bunch, but maybe falls out of bed like some of these other retailers. And so I want to limit the range of potential outcomes. So I'm going to sell a covered call. And, based on the range, it might have made sense to sell like the 30 strike for two reasons. I mean, the first reason would be because the stock's at 26, 27, and you're capping it at 30. So you still got a decent amount of upside if you get a positive response to earnings. With these earnings announcements, you do want to participate if it works. So you don't want to sell the call too close. And looking at the chart of Urban, it would have made sense to sell the 30 call. And then in terms of protection, again, the stock's at 27. You don't usually buy an at-the-money put because it's expensive. So you go a little bit out of the money. Maybe you buy the 24 strike put. Maybe you buy the 25 strike put. But that limits your downside. So now I have the right to sell the stock at 25. So I don't really care if it goes to 20 or 21 or 22 or 23. I'm limited down at 25, okay, or protected at 25. And then on the upside, I got participation up to about 30, okay. And so then you enter this uncertain event with a little bit more certainty. You've defined your outcomes and you're comfortable with them. Easier to roll into earnings with that type of position. Well, fast forward. What did Urban do? Shot the lights out. It's up 15%. It's bounded beyond your $30. Okay. So on the risk graph we drew here, essentially the stock, which was kind of in the middle, right? Which was kind of like right here, it's jumped and it's all the way up here. It's beyond kind of the max profit zone, at least at expiration, right? The question is, what do you do? How do you manage the collar now? How do you manage the collar now? You have a couple of choices, but a couple of decisions you got to make on both sides. So let's take them one at a time. What about the protective put? You bought that put, presumably. See, you didn't have it before, okay? You were comfortable with Urban without earnings, but going into earnings, you wanted the protection. Well, the cat's out of the bag. It had a good response. This 25 put, which I bet you didn't pay more than 40, 50 cents for it because it was so far out of the money. But assuming you did the front month, June, that 25 put is now at 15 cents. So it's lost most of its value. It's lost most of its value. So what do you do? Well, you have a couple of choices. Number one, you could leave it on. But what are the chances that Urban is going to go back down below 25 following such an epic earnings response? I just don't think that's going to happen. Okay. But you could leave it on just in case it does. Or you can take it off and be done. Just if you bought it for 40, 50 cents, you're selling it today for 15 cents. You lost some of the value, but that's the cost of the insurance. They're not free. And I'm sure you'd rather lose a few bucks on the put and have the stock go up $4 than have made money on the put. So it's a good outcome. It's a good outcome. So take the profit or just take the put off, salvage what you can. You don't need the insurance anymore. The event's over. Okay. I don't think at this point you need to rebuy a new put and then rebuy a new put. I mean, unless you're trying to collar this thing every single month, which is, I think, very hard to make money with if you're doing that because you're buying insurance every month. If the event has passed, you're done. You don't need the insurance. If you want to let it ride, you only got 15 cents more risk, let it ride. If you want to take the profit, take the profit. Do you need to rebuy a new put? Probably not, because, again, we've got a positive resolution. The trend has been reinforced. Presumably the downside is hopefully limited at this point by virtue of how strong the stock is. That's the easy one. Peel off the put or let it ride and risk the last 15 cents. The trickier one is, what do you do with this 30 covered call? You willingly capped your gain in the stock, and it's now rallied beyond the cap, but not that far beyond. I mean, it's only 65 cents in the money. If you take a look at that June 30 call here, it's got $1 of extrinsic value remaining, buck 6, buck 7 of extrinsic value. It's worth about $1.80. So what you do now really depends on how optimistic you are moving forward. Okay. If you want $1.80 of protection in case Urban pulls back and starts to fill the gap, I think you could stay in that 30 call for a little bit longer and milk the remaining extrinsic value. You got another $1 of upside. It's about a 3% return on a $30 stock. Okay. The challenge is that's all your profit can be. You are capped. You can only make $1 for the next 23 days. If you think this gap jump starts a little bit more upside over the next couple of weeks, you may want to lift the ceiling. You may want to buy back that 30 call and roll it up to like a 32 or a 33 or something higher to give yourself a little bit more profit potential from this point forward. And I think you could even stay in June. I don't know that you have to even jump to July yet. So you could just buy back the June 30 and roll it up to maybe the 32 or the 33 and up the ceiling. If you said, I want a little more premium, then you're going to have to roll further out in time, either to a weekly or maybe even jumping out to July. But that one I think is more the personal preference. Okay. For me, I feel like you got to give this a chance. Got to give the breakout a chance to work. You got to be open to the possibility that this starts, more upside. And then you have to ask yourself, are you okay with just $1 more upside for the next 23 days, or do you want more? And if you want more, I think you're rolling up that call to whatever level makes sense to you, okay, to where you'd be satisfied with the upside.